1031 exchanges, and we're posing the question, can you exchange your rental property for a better lifestyle? And before we get into that, we just want to thank you for joining. You may be joining for the first time from AOAUSA.com, and you can join from YouTube. You can watch it after the fact. There's actually a whole lot of videos you can watch on YouTube. Just search up AOA USA and you'll find that. And also be sure to subscribe, and then that way you won't miss anything. All right, so April 10th, we have a few different things that are going on. April 10th, we will have another live stream. Radical Eviction Trends Impacting Your Investments is the title on that one. And attorney Michael Brennan will be sharing on that. And then the biggie is the AOA Million Dollar Trade Show and Landlording Conference. We're going to be having that at the LA Convention Center. And if you're looking to take your business to the next level, you definitely want to go. You want to just make sure you're always sharpening the axe. And this is a perfect time to just carve out a day to spend learning from a lot of different people. We'll have over 20 speakers, vendors galore, and all of them are there. Their services are really tailored for you as rental property owners, investors. And so it should really be a very impactful time. If you've never gone, or if you know someone who's never ever been a member, definitely invite them. They will get a free 6-month membership to AOA, and that's access to everything, all the forms and content, everything. So definitely bring somebody. We're looking forward to seeing you there. And yeah, other than that, there's another conference that we're having in San Diego in May. So there's a couple different things going on, and we hope that you're able That's just one service that we have for AOA members exclusively. And anyway, for those of you, if you have a 16 unit building greater, you were supposed to have offered that, I guess, offered rent reporting to them as of April 1st. If you didn't get to it, well, just get to it. $5 per renter per month, and or a total of $10 per unit if there's more than one renter there. And anyway, so that's something that we can help you with. Hope that we're able to. Yeah, and if you and I did forget to mention, you can go to the AOAUSA.com website and find out more information about the trade show and actually sign up for it. And I will see you there. All of us will see you there. Should be awesome. So just want to have a shout out to 1031 Capital Solutions today for making this live stream possible. Our speaker is the managing partner at 1031 Capital Solutions. He's the author of How to Retire from Being a Landlord, UCLA graduate, and he's the grandson of Proposition 13 author Paul Gann. And he has extensive experience in real estate taxation and investment syndication with security licenses since 2003. He brings deep expertise to 1031 qualified investment programs. And anyway, so we're really glad to bring you on. Richard Gann, how are you?
Well, thanks so much, Jeff. And hello, everyone. Thank you for joining us on what I hope is a great day wherever you are. I know you probably have a long list of things that you could be doing that are more fun than attending a real estate webinar. So I appreciate every minute of your time. Again, my name is Rick Gann. I'm a managing partner at 1031 Capital Solutions. And my goal for this webinar is to help answer the question on the screen, which is, can you exchange your rental property for a better lifestyle? And for the most of the people on this call, I believe the short answer is yes. And hopefully you'll come to the same conclusion by the end of this call today. Before we go any further, I am required to tell you that this presentation is not a solicitation. Real estate securities may not be suitable for all investors. The risks of investing in real estate programs are no less than the risks of direct real estate ownership. Investing in securitized real estate programs typically involves higher fees than traditional investing. Investing in mineral rights, which we'll talk about briefly, is highly sensitive to energy prices. And although the name of our company is 1031 Capital Solutions, we do not give tax or legal advice. Okay, a little bit about us quickly. The 3 branch offices in our network are in San Diego, where my partner Jason McMurtry is, in Sacramento, where Jamie Furlong heads up the NorCal team under the Legacy Investments banner, and Seattle, where I spend most of the year, although I'm coming to you live from Palm Springs right now. In addition, we have folks working remotely in Oregon, Colorado, and Los Angeles. And I encourage everyone to visit our website, 1031capitalsolutions.com. That's 1031capitalsolutions.com, where we have copious articles, blogs, videos, and educational content. In a nutshell, we are a financial services firm that exists for the purpose of helping individual property owners retire from being landlords. And as Jeff mentioned, about 5 years ago, we wrote a book on that very topic, and that's available both in print and electronic formats on Amazon. But if you go to our website, you can easily find a link where we will ship that book to you for free. So do not pay Amazon. Let us send that book to you directly. Again, that's at our website, 1031capitalsolutions.com. And we'll try to provide some time for Q&A. But if somehow we don't adequately address a subject or answer a question during this webinar, you are welcome to schedule a call on our website for a free consultation. Okay. So I want to kick things off by telling you things that you already know, which is that today, being a landlord, especially on the West Coast, has a long list of headaches and hassles, all of which are motivating many folks, especially folks who are, in the latter half of their real estate investing career, to consider selling their rental properties. And I think a lot of you probably attend a lot of AOA webinars where getting educated on what's happening regulatorily, what's happening with landlord-tenant law, as well as vendors, talking about all the ins and outs of property management, asset management. So I don't need to tell you what are the reasons that so many people consider selling their rental properties up and down the West Coast. I will say, though, that the most compelling reason to sell a rental property, from my perspective, is because the yield on your equity no longer justifies the hassle and liability of owning that particular property. And this is an increasingly common phenomenon, especially for landlords who own properties that could otherwise be sold as a single-family residence or condo or townhome. Specifically, when the equity in your property increases faster than your rental income, eventually the yield from that property as a percentage of your equity will become a very low single-digit number. Over the last 50 years, U.S. home prices have increased 2.4 times faster than average rental rates. And this ratio is undoubtedly higher on the West Coast. On top of that, if you bought a property with a loan, your personal equity could have increased by 6 or 7 times, even if your property value only doubled. And the point here is that the actual net cash you are putting in your pocket every year after accounting for vacancy, turnover, and capital expenditures could be such a low percentage of your equity that the income no longer justifies the hassle and liability of being a rental housing provider, especially on the West Coast. To do that math, by the way, we have a proprietary software system that can quickly and easily assess the financial health of your rental property. We have literally used this software with hundreds of clients, and it's a great way to take the first step in deciding whether to sell or keep a particular rental property. We are happy to provide that service to everyone on this call. Now, despite having plenty of information, it is still common for clients to remain reluctant about selling a rental property. And some of the more typical concerns we hear include believing that the property could still appreciate despite what may be massive changes in the forces that once drove up that property value, fearing that you won't be able to find a replacement property, which is reasonable, not wanting or not being able to obtain another loan, another very reasonable concern when you're considering selling and exchanging a property. Good old-fashioned procrastination, and of course, the very legitimate fear of capital gains taxes. And so the solution that I'm here to talk to you about briefly, and by the way, I could spend hours on every slide here. So this is, a very cursory discussion over topics that we typically end up spending hours engaging our clients on. But ultimately, what we're talking about is doing a 1031 exchange in which you sell your current rental property to a third party and then redirect the proceeds of your sale into what we call a passive replacement program. And it's that combined transaction of selling your property, exchanging, and then reinvesting into a passive replacement program that ultimately leads to what we describe as improving your lifestyle and ultimately retiring potentially from being a landlord. So just this, and by the way, this is not intended to be a 1031 exchange educational seminar, but it's always a good opportunity to refresh everyone's recollection on the basics of 1031 exchanges. And I happen to believe that everything you need to know really about a 1031 exchange is on this screen. So if you'll just go through a quick mental exercise with me on this quiz and sort of test yourself on your 1031 exchange knowledge, in a complete 1031 exchange, you can defer all of what type of taxes you would otherwise have to pay. And the answer, of course, is capital gains taxes. When you conduct a 1031 exchange, all proceeds of the sale must go directly from escrow to who? And the answer is a qualified intermediary. When you do an exchange, all the net proceeds from your sale have to go to a qualified intermediary, also known as an exchange accommodator. After you close escrow on your relinquished property, you have how many days to identify your replacement property? And that is 45 days. 45 days from the day you close. That's what we call your identification period. Similarly, after you close escrow on your relinquished property, you have how many days to actually complete the purchase of your replacement property? And the answer is 180. Same starting point, the day that you close escrow on the rental property you sold, that date triggers the 45-day identification period and the 180-day close deadline. To successfully defer all taxes in a 1031 exchange, you must replace the entire value of your rental property. This means replacing all of your equity and all of your debt. You have $1 million property and you have a $500,000 loan, you have to buy $1 million worth of real estate in a 1031 exchange, even though you only end up with $500,000 in the bank. The IRS requires you in a 1031 exchange to replace the entire value of the property you sold, net of commissions and transaction expenses. So, if for most people that don't have an extra $500,000 laying around in the bank, what that really means in an exchange is going out and getting another loan to replace the $500,000 loan you just paid off. And one of the things we're going to talk about is how you can do a 1031 exchange into a passive replacement property without needing to get a loan. And then finally, since 2018, 1031 exchanges are available only for what kind of investments? And that's, of course, real estate investments. They used to be able to do other types of 1031 exchanges involving cattle or farm equipment or airplanes, but today we're just talking about real estate, and that's okay because everyone on this call only cares about real estate anyway. All right. So, passive replacement program. What do we mean by that? Passive is referring to your participation or lack thereof in the underlying real estate that you're investing in. These are properties that are sponsored and managed by huge real estate operators. Some companies that put these programs together literally have billions of dollars worth of real estate under management. The investments are therefore securities under federal and state law because When you invest in a program that you are not directly participating in as an investor, that is the definition of a security. And so not only is this a real estate transaction, but it's also a securities transaction. And as such, because these are private placements, investors in passive replacement programs must be accredited, which is typically based on your net worth or your income. As it turns out, it's sort of hard to own rental property on the West Coast without automatically being an accredited investor by the virtue of the value of real estate on the West Coast. So we don't have too much trouble running into people that are doing 1031 exchanges that aren't already accredited investors. Replacement. Replacement means that these investments are qualified as like-kind real estate for purposes of a 1031 exchange, meaning that they qualify as a replacement property so that when you do a 1031 exchange, not only can you exchange into these properties, but then exchange back out into other 1031 qualified real estate when that property is sold, and possibly even go back to owning traditional real estate if you so desire. So replacement refers to the fact that we qualify as replacement property under the 1031 rules. And then we use the term program, passive replacement program, because you are investing in real estate, but ultimately these are pooled assets. There could be one property, there could be a dozen properties in this pool of assets in the program, and your interest in that real estate is fractional, meaning if you and possibly a few hundred other people have invested in all these different 1031 exchanges, all into one program that is aggregating the capital of all these folks who are doing their own 1031 exchanges, and all are treated as fractional owners in the real estate in the passive replacement program. Did we mention passive? When I say passive, it's hard to exaggerate how passive these programs are. There's no searching, negotiating, or closing on the underlying real estate by you. That's all been done. You're not seeking tenants. You're not screening, leasing, dealing with deposits or rent collection. There's no maintenance, expenses, or bills, no property tax or insurance payments for you to worry about, and no legal liability or evictions or landlord-tenant laws or regulations that you need to concern yourself with. You are investing in a passive replacement program that in all likelihood is not on the West Coast, and then simply receiving a monthly or quarterly payment into your checking account and having no involvement, no voting, no signing forms in the future. And for some people who really like to roll up their sleeves and be very active in the real estate that they own, it's probably not for you. But for the folks who are looking to retire from being a landlord in their real estate, the truly passive nature of passive replacement programs is quite a draw. In addition, there are the built-in non-recourse financing on most of these programs is also quite a benefit and quite attractive to folks that currently have debt on the properties that they would be selling going into a 1031 exchange. And as I mentioned, and I think most of you know this, but just it's worth reminding that, again, you have to replace the debt on whatever rental property you sell in a 1031 exchange. You can add cash, so you don't have to get another loan. But as I mentioned, most people don't have the ability to replace the loan that they had on the rental property. That's why they had the loan in the first place. And when you invest in a passive replacement program, you are replacing that debt without actually having to apply for a loan, because there is built-in non-recourse financing already in place for these passive replacement programs. And so the entity that owns the underlying real estate that you are investing in, it already has a loan before the first investors walk in the door. There's no loan qualification. There's no loan application. You're not a party to the loan agreement. The bank doesn't even know who you are. There's no personal recourse liability. You're not responsible for payments. You didn't have to sit in front of a notary and sign loan docs. There's no public record of that debt. And when you sell your rental property, that loan falls off your credit report and improves your credit rating. And when you invest in the DST, because that debt isn't linked to you contractually, it's as though that debt is off your balance sheet. And to be able to replace the loan that you had on a rental property in an institutional caliber real estate program without having to lift a finger to be allocated your pro rata share of the loan on that investment program. For a lot of people, it's too good to be true. They can't even believe that this is possible. And we've happily been able to help many people do an exchange and overcome really what was for them the biggest obstacle to wanting to sell their rental property in the first place, which was dreading not only the real estate transaction, but really dreading having to go and get another loan. Okay. So I've got three categories of passive replacement programs I want to quickly talk to you about. Our first example of a passive replacement program is a property or sometimes a small portfolio of properties held by a Delaware Statutory Trust or DST. You may have already invested in a DST and didn't know it, as many mutual funds and other investment companies are formed as Delaware trusts. But in 2004, the IRS issued a revenue ruling that allows property held in a DST to be treated as 1031 qualified replacement property, even though the investors are not directly on title. And this is because the DST investors have the same economic interest in the property as if they were direct fractional owners, but without the legal liability that comes with having your name on the deed. There's typically 1 to 3 properties in a DST, although there could be as many as 30, but typically 1 to 3 properties in the program, anywhere from $25 to $250 million of portfolio value, usually somewhere between $100,000 and $500,000 minimum investment. The most popular sectors are apartments, industrial, and self-storage. The Southeast, Texas, and Florida, Colorado, these are the typical locations for these properties. You're going to hold on to a DST investment, usually for 5 to 10 years. The historic average has been about 7 years. Some of these programs do not have debt, but the ones that do typically have between 30 and 55% leverage on the real estate in the program. Most of the time, you're going to get a yield between 4 and 6%. The average is probably around 4.5% right now. And when I say yield, I mean what is the net amount of dollars going into your pocket as a percentage of the equity that you invested in the program? 4 to 6%. Most of them are between 4 and 5. And that income is deposited automatically monthly or quarterly, as I mentioned, into your checking account. That's an overview of something I can spend 10 hours talking about in a minute, but that is a description of the most popular passive replacement program known as the DST, Delaware Statutory Trust. The second most popular categorically are what's known as the pre-REIT properties. And a pre-REIT property is essentially a two-step process where you do a 1031 exchange today with the rental property that you're selling. You're going into a property that's typically been pulled out of a real estate investment trust. Most of these have multi-billion-dollar portfolios of real estate. And the REIT will pull a property out, package it up as a 1031 investment. You have a fractional interest in that particular property for 2 to 3 years. And then the REIT reabsorbs that property back into the real estate investment trust under what's called a 721 exchange. And when the dust settles on the other end of that process, you are now a fractional owner of a multi-billion-dollar REIT portfolio rather than just a DST. So it's a strategy that allows you to ultimately end up in a REIT rather than property after property doing multiple 1031 exchanges over time, with the caveat that you cannot do a 1031 exchange out of a REIT. So it's kind of it's a one-way path into the REIT, but in exchange for not having the opportunity to do a future 1031 exchange once you're in the REIT, you do have enhanced liquidity. And 1 year after going into the REIT, these REITs have a redemption program that allows you to fill out a form and pull out any dollar amount up to your investment amount, with the same approach that you would redeem from an investment fund. So enhanced liquidity, much more diversified portfolio, stable income, but without the opportunity to invest in a future 1031 exchange. And then the final category that we offer of passive replacement programs that also qualify for a 1031 exchange are mineral rights. And in a mineral rights program, you are investing in essentially a basket of mineral rights across hundreds of parcels, perhaps in multiple basins, typically including the Permian Basin in Texas. And what you're really investing in are deeded rights to receive royalties from what could be hundreds of oil and gas drills across a vast geographic area. And so you're getting the diversification across all these parcels of the drilling activity that's happening today, tomorrow, and in the future. But of course, this is a much different risk profile than typical real estate. And ultimately, what you're investing in and what you're most sensitive to in a mineral rights program is the price of oil and gas. So these are not for everybody, but to the extent that someone wanted to do a 1031 exchange and mix into their replacement portfolio something that would truly be diversified from the traditional real estate and get some exposure to the energy industry, this can be a great solution for the client with the right suitability and the right risk tolerance. So we do like this as an opportunity to add a little spice to it. Is otherwise a pretty boring real estate in the DST and pre-REITs. And that boring is good when you're trying to preserve your capital and focus on income, and ultimately with the goal of having your real estate generate income for you over your life until you pass away, and then triggering the step up in basis upon your passing and having your kids be able to inherit relatively easy assets to receive, to own, and ultimately liquidate upon your passing. And with that, Jeff, I know we're coming up at the end of my time, so I pause here and see if we've got any questions pending.
All right. Thank you, Richard. Yeah, so far. Yeah, so if you have a question right now, then they'll get that question over to us for us to ask here. And if you're on YouTube or Facebook, yeah, just go ahead and type in your question and we can get to it. All right. So yeah, okay, here we go. We already have a question. I was going to ask one. But here we go. Let me get to this. Okay. John on YouTube. I'm interested in planning for inherited paid off rental. Should I wait to inherit it to get basis adjustment, or will the same happen if DST or exchanged property?
Good question. All of the strategies I've mentioned, and in fact, all real estate receives the same benefit of the step up in basis. And so when someone passes away owning a rental property or a DST, or they ended up in a real estate investment trust, in all of those examples, or mineral rights for that matter, in all those examples, upon your passing, your cost basis in that real estate, no matter how low it is as a result of years of 1031 exchanging and depreciation, all of those categories get stepped up to whatever the value of that real estate is on the day that you pass away. And then your heirs, if they liquidate those assets very soon after you pass away, are not going to pay any capital gains tax, because they only pay capital gains tax on the difference between the value on your date of death and the value of the real estate when it's sold.
Great. And let's see. Yeah, so no other questions right now. On the one thing that it seems like is kind of an advantage is having, like, if it's in a REIT, you don't have that reset happening every 5 to 7 years. There's a reset where it's a sale, you're losing a certain amount uh, for just fees on that. In the REIT, that doesn't, it seems like it's a little more steady of a growth. Am I seeing that right? Or yeah, let me know what you think about that
Sure,
idea.
no, that's right. The clients who are interested in the pre-REIT option really are attracted to the fact that ultimately, for most of the years that they're going to be in that investment, what they're really exposed to is a portfolio of hundreds of properties, typically across multiple sectors across the whole country. And when you have that level of diversification, it really evens things out. They're incredibly stable distributions from a multi-billion-dollar real estate investment trust. And you're right, you are beyond that initial transaction, you no longer have to worry about future 1031 exchanges. And so people like the fact that's their last exchange they have to do with that property. They like the fact that they've got this stable income, and they like the fact that they can really at any time after the first year redeem any number of their interests from the program. The folks who ultimately decide not to go into in the pre-REIT option are usually folks who still want to hold on to the option to reinvest in traditional real estate. And so we have had clients that go into a DST and are of the belief at that time that 6-7 years later that there might be some opportunity for them to go back to, because they like the art of the deal, they want to go back to maybe buying another rental property, and which I honor that. The truth is, from my chair, we never see that. The odds of someone who wants to do a DST today, 7 years later, wanting to go back to owning and operating a rental property are pretty slim. But it's not my job to second guess your decision making process. And so I want clients to be happy. But I will tell you that the vast majority of people, I mean, almost everybody who invests in DST, they end up going into another DST unless somebody has passed away. So I don't even know of an instance where somebody sold the DST and then exchanged back into rental property. But to your point, Jeff, that's, if you do that multiple times, there's the cost and hassle of having to do multiple 1031 exchanges over your life. And some people do want to avoid that with the pre-REIT strategy.
All right. And then Matthew here is asking, how long has your company been doing this? So 1031 Capital Solutions, when were you established?
Yeah, the firm itself goes back 6-7 years. I will say though that I have been, and my partner Jason McMurtry, we have both been in this industry for decades. I started off working at what was then called Grubb and Ellis, which was a top sponsor of the old tenant in common programs those were the more popular 1031 exchange passive replacement programs back in the day. The 2004 ruling had just happened, and it took a few years for the DSTs to really catch on and become the go-to solution for these passive replacement programs. I spent most of my career really working for the sponsors of these real estate programs. But 1031 Capital Solutions itself, in its current version, with Jason and I owning that, and the folks on our team, goes back 6 or 7 years.
And then it says, how much assets are you managing right now?
Hundreds of millions of dollars of assets.
Hundreds of million. Okay. And did you say you distribute cash flow monthly?
Well, most of the DST programs do have a monthly distribution. And there's just a small handful that will do a quarterly distribution, but the vast majority is a monthly distribution, typically right in the middle of the month, based on the prior month's performance. And I will say though that almost all of the really good DST sponsors will really try to reset their monthly distributions on an annual basis. And so even though in an apartment community, the revenues and expenses are fluctuating every day, what the sponsors typically try to do is project, forecast, and then have, on a yearly basis, a fixed percentage and then do a catch-up at the end of the year, and then announce what the next new anticipated distribution rate is going to be for the following year. So my point of all that is it is monthly, but the sponsors do a great job of keeping that monthly distribution as predictable as possible.
All right. So Dave is asking about it a little bit more. For the 4.5 to 6% return on investment, is that after taxes on the income, or is the 5% still subject to tax?
Well, it's a good question. So when I'm talking about the distribution amount, I'm literally talking about how much cash is the DST putting into your checking account as a percentage of how much you invested. That's that number. Now, from there, depending on your history on your 1031 exchange, you likely are going to have depreciation deductions that you get to apply to that income. So you're going to receive that net income from the property, and then your accountant will apply whatever depreciation deduction you have to that property, to that income, excuse me, and then the remainder is taxable as income to you. But how much depreciation you're able to claim is unique to every person, because in a 1031 exchange, you're carrying over your depreciable cost basis from your prior property. And then to the extent that you bought more real estate than you sold, because perhaps the leverage on the DST was higher than the property you sold, many of our clients will pick up new depreciation in a DST. And so they'll increase their depreciation deduction from what they had on their relinquished property. But the short answer is, that number I'm quoting is how much you're receiving before you apply any depreciation deductions and taxes.
Great, thank you. And John, DST acquisition has loaded costs like closing costs and broker fees like real estate would.
Yeah, all these programs have built-in cost, expenses, and fees. And the best way to explain this is a DST sponsor is going to, for example, go buy a $90 million Class A apartment community in a suburb of Jacksonville, Florida, and then package it up, and 6 weeks later, it's a $100 million DST. And where did that difference, come from? How are they reselling that as a DST property for more than they paid for it 6 weeks ago? And there's really four categories of costs on every DST that explain that markup. First is the reserves, because they have to gather reserves from the investors up front, because they're not allowed to come back to you and have capital calls after the fact under IRS rules. So there's a healthy amount of reserves on most of these programs. And then there's the transactional cost of the deal, the loan fees, all the traditional real estate transaction costs that are added to the transaction. Then there's the acquisition fee, essentially the profit that the sponsor has baked into the deal for putting the program together. And then there are the syndication expenses, and from that, the commissions that we get paid. And so those are your four categories really of costs. And every DST program is marked up from whatever price the sponsor paid for that property a few weeks ago or a few months ago to the offering price. And if you invest $1 million in that DST, 100% of your $1 million goes into that program. Nothing gets taken off the top, so to speak, but you're still indirectly paying those expenses because they've all been built into the cost of the property.
All right, Brenna, can I do an exchange for a building and a personal property as long as I have money left over from buying an income property?
Well,
So
I
I
think
think
the
they want
short
a personal property, so I'm assuming that's not a income generating property, but just a residential for their own use property, it seems like.
That's right. Yeah. Unfortunately, the short answer is no. When you do a 1031 exchange, unless you're adding more capital than to the exchange than you sold, you are required to replace the entire value of your rental property with property that qualifies for a 1031 exchange. And what doesn't qualify for a 1031 exchange is a personal residence or personal vacation property. You can buy land, for example, that you might decide to build on years down the road. But ultimately, all 1031 qualified real estate has to be for business or investment purposes. And something that you are immediately going to use for personal use unfortunately doesn't qualify for a 1031 exchange.
And then Abbas is asking, so can you do a partial exchange? And what does that look like?
We routinely have clients that will purposely withhold cash or reinvest some portion of their proceeds in something that doesn't qualify for a 1031 exchange. And that the term we use for that is intentional boot. The term boot refers to the extent to which you didn't replace the value of your rental property with new 1031 qualified real estate. And so intentional boot means, a simple example is you sell property for $1 million and you decide, I'm going to buy a $900,000 property and I'm going to put $100,000 in the bank because I want to take the opportunity to put some money in the bank. That's okay. That doesn't blow your exchange. It's just you're going to pay tax on that $100,000. And in California, that's going to be 35+% between state and federal tax. So as long as you recognize, hey, that $100,000, a third of that's going to be a tax bill at the end of the year, you are entitled to take as much cash out of your exchange as you want, and without jeopardizing your exchange. You're always going to pay tax on every dollar that you fall short of replacing the value of your relinquished property.
In Alexandria, are the fees tax deductible?
Well,
So
there in any real estate transaction, there are expenses, whether it's a DST or traditional real estate, that the IRS allows to be deducted as an expense of the transaction. And then there are others that you can't. And that's a whole topic, by the way. So the answer is it depends. But for example, a qualified intermediary will typically charge, $1,000 to $1,200 usually for a 1031 exchange. The IRS allows you to pay that and therefore reduce the amount that you're required to replace, because they'll treat that as a legitimate expense of your sale, just like paying real estate commissions or title transfer fees. Anything that is a customary real estate transaction expense you are allowed to deduct for purposes of a 1031 exchange. And then there are other line items on an escrow that don't qualify. Certain loan expenses don't qualify, or certain reserve payments don't qualify. So, but I'm happy to go into detail on what may or may not qualify offline. But just be aware that the short answer is anything that is a traditional transactional expense of a real estate purchase or sale is an allowed deduction for purposes of calculating your 1031 replacement requirement.
So if they call the number that we have there for you, that 800 number, does that go to you, or is someone else who answers that call?
If you dial that number, then you'll get a directory, and my name is one of the options, and then you'll get directed to me. And if I miss your call, I will call you right back.
All right. Maybe you have an extension number if without the directory?
I'm not sure what my
Okay, that's okay. Don't worry about
it
it.
should be
We have
one.
a few more questions here. Alexandria, again, if your property is held as your personal trust, you have okay, so I think did I cut off on you there?
Yeah, if you could repeat the question.
Yeah, so if the property is held in a personal trust, does that have an impact on the transaction?
Generally, no. The IRS disregards a traditional revocable living trust. That's something that you are typically not treating as a separate entity. You still file your taxes under your own social security number, even though you have a revocable living trust. So for 1031 exchange purposes, having a traditional revocable living trust is not a factor in an exchange. Where people get in trouble is they've got a partnership or an LLC some business entity, and then they'll do a 1031 exchange and try to dissolve that entity or somehow change ownership in the middle of the exchange, and that's a big no-no. And so you really have to be careful with entities in a 1031 exchange. The golden rule is buy your replacement property with the same title of whatever you sold, and then you avoid trouble. But if you sold it in the name of your living trust and then bought it in your own name, for example, that's not going to disallow your 1031 exchange, because at the end of the day, it's still the same taxpayer doing the exchange. So longer answer than you were looking for, but no, not an issue with a traditional revocable living trust.
One last question. Are closing costs and commissions deductible from the sale proceeds of the rental property?
Generally, that is true. Any transaction cost that is typical of a sale, it reduces your replacement value. So just to be really clear, if you sell a property for $1 million in a 1031 exchange, you do not necessarily have to buy $1 million worth of real estate. You have to buy $1 million minus the commissions, the title and transfer costs, any of the typical escrow line items that you would see that are related to the expense of the sale, the transaction itself. Those all reduce the replacement value that you're required to meet on the other side of your exchange.
Awesome. Well, am I going to see you at the AOA trade show?
I think you're gonna see my
Million
partner
dollar
Jason.
trade. Huh?
I think you're gonna see my partner Jason at the trade show.
Jason's going to be there. Okay. Do you know what you guys are giving away? You have a raffle for anything?
Oh gosh, no, I wish I had a good answer for that. I
Okay.
don't.
Lots of the vendors, they'll have a little raffle and give away like a $100 different things that they're giving away. We give away 5-day cruises for two and an Apple Watch. And so it's fun when people hear their name called and just to see that. It's just always fun. But anyway, it was great to have you on as always. We really appreciate you and your expertise. And we'll see you next time around.
Thanks everybody. Thanks Jeff. Have a good day,
Okay.
everybody.
Take care.